Today, what's driving vehicle finance? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I'm joined by Scott Montarello, the founder and CEO of a company called Driva. Hi there, Scott.
Hi Martin, thanks for having me.
Great to have you on board for a chat. Very interesting times, of course, but you are there as essentially a portal to allow people to get information and apply for various vehicle loans, both for commercial and personal vehicles. I'm interested in a bit about your business, but also interested in what you're seeing. So let's start with a little bit about the background of the business. So how long have you been operating for?
Yeah, sure. So the company was founded in September last year. We went to market in about start of February this year. And really the intention behind it is we're just really looking to simplify and empower customers as part of what is a pretty complicated and we think intentionally confusing car finance process.
Intentionally confusing? Well, I'm not so funny that in the finance sector. Right. So basically what you do is you allow people to come on and look at the different lenders and basically get some comparative data.
Yeah, exactly. I mean, if I go back to where the business was founded, it was through a pretty painful experience I had as a customer a few years ago, which was, going to a dealership, finding a car that I was really happy with, and then being passed around from office to office as I went from the finance person to the insurance person. And all the while, I don't really know what's going on, what the rate's going to be, what fees they're charging me. And in my case, 2 days later, I find out that I'm declined. And then literally about a year later, I realized I also put a bunch of inquiries on my credit file, which then later impacted my credit score. And I still couldn't get the finance that I was after and ended up shopping around online to many different lenders' websites. So what our platform seeks to do is a really simple one-stop shop for a customer to come to us, punch in a few details. We then have a proprietary database of all the lenders' pricing policies, their credit policies, and we can instantly tell a customer, this is the exact rate you'd get with each one of our lenders. And it is the exact rate and not a generic starting rate, which is what you get on most other websites. And all the fees are disclosed up front. And the monthly repayments are it's a like-for-like comparison between every single lender.
Right. So there's a couple of really interesting observations. Firstly, the point about the credit score is something people don't understand, right? But quite often the process will inquire on the credit record and may even leave a print. And that can be a problem if it's done a few times. So your process alleviate that. And in fact, I noticed on your website, you specifically say this doesn't impact your credit, right? Credit score.
Yeah.
And that clearly is right back to your personal experience.
Exactly, yeah. And it's something that it is quite unknown by most Australians. And I didn't realise this really until we were starting the business. But it's every time you go to a lender, whether you're going for a credit card or a car loan or anything else, it's leaving a mark on your credit file. And if you have lots of inquiries on your file, it doesn't really matter if you're accepted or declined. It's impacting your credit score. And over time, that just decreases that score and then means your rates are higher the next time you go to get a loan or you're going to get declined.
Right. And then the second point is you make a really important point that the indicative rate that you often get off other sites translates into quite a different rate once the transaction is actually being assessed and processed, whereas the definitive stake in the ground with your rates are the rate is the rate.
Yeah, exactly. And it's such common feedback that we get from customers that end up coming to us that they've been through, a credit scoring website or some of those, rate table websites that you see online, and they see that they're going to be eligible for a 4% interest rate. And then as they apply, they get that inquiry on their credit file. And then they realize, actually, now my rate's 12% and they're not happy with it. So our process takes that pain away and we can get the customer's credit score. And because we're not a lender directly, we can do it without leaving any inquiry on the credit file. And then we can still tell them exactly what the rate would actually be with each of the lenders. And we have no preference either way which lender the customer picks. So we very simply and clearly display what the anywhere from 1 to 20 options that customer might be eligible for, and then the customer can pick whichever one they want to go with, and then we help them go through that process and get the documents they need to ensure that they're actually going to meet the lender's credit criteria.
Right. So you mentioned auctions, and that's the important point, right? So basically, you can put an inquiry in, and then basically you can get the best from a number of different potential offers.
Yeah, exactly. We have a broad panel of lenders, and as you said, it's covering both that consumer space and personal car loans, as well as the commercial car loan space, and we have lenders that cover both. So that the customer can pick whichever lender they like, and we also display like what are the key features of what each lender is, and things like early termination. For a lot of car loan lenders, if you want to end the loan in year 2 of a 5-year loan, you're going to be whacked with a really large exit fee. But if the customer knows ahead of time that they're likely to pay it off early, we can just make sure that the rates that they see are only for lenders that allow you to pay it off early without those extra fees charged.
Right. So again, more transparency, and that's always good for consumer choice. Now, with regard to the panel of lenders, I noticed that you've got a couple of the majors listed there for the consumer end, but not everybody. Now, what's the story with regard to the panel of lenders?
Yeah, so maybe if I start on the consumer personal loan side of things, we're actually finding most of our loans are going to more of the non-bank, less traditional lenders. So lenders like Plenty, which used to be called Rate Setter, Wiser, First Mac, some of those ones which a lot of people haven't heard of before, but they offer really competitive rates, much easier processes than some of the more traditional lenders like Pepper and Latitude that require you to literally print a 30-page document, hand sign every page, and then scan it back. And it's just quite a frustrating and a time-consuming process. Whereas, those Plenty and Wiser type lenders are very fast, streamlined, can get it done in really a day or two. So we're finding a lot of our volume goes to them. Also have quite a deep panel, so we can really go, if you do have an impaired credit history of defaults or previous bankruptcies, we do try and make sure we have an offer for every customer. So lenders like Money3 and Liberty that are happy to accept more impaired credit, we have options there as well. And then on the commercial side, that's where most of the big 4 banks play. So we still have like your Macquarie's and Angle Finance and some of those newer commercial lenders. But we also have ANZ, NAB and Westpac, which are the larger ones in the commercial space, which do get some of our volume. But as I said, a lot of it is really going to those newer lenders that are, I guess, less strict on their policies and also have much faster and easier processes for the customer.
Okay, and CBA seems to be missing off the list.
Yeah, so CBA is an interesting one. So they do personal loans for cars. They typically, because it is personal and it's an unsecured car loan, the rates start a lot higher. So they might start from 12% and then go up from there. So it's not an area to play in because we are specialised in car finance. It makes sense for us to really focus on those secured car loans where the rates really do start from 4% and then go up from there. And then on the commercial side of things, it's not an area that CBA plays in at the moment.
Very interesting. And again, I think there's a lot of complexity in this sector of the market, which is not well understood. And as a result, many people end up with loans that are way more expensive than they perhaps need to be. So, there is definitely a potential price advantage by shopping around and getting the right information and using the right tools to be able to actually make the better decisions.
Yeah, exactly. And it constantly surprises me how you can have the exact same customer, and it could be a really strong credit customer, has a property and has never missed a payment on any of their facilities. And they might have a rate variance of anywhere from 5 to 10% across their top 10 lenders. And then you take that, you take a different profile and their top lender would be completely different. So because car loans are risk-based pricing a lot of the time, so meaning that the rate fluctuates based on the customer's credit score, it is really a very much a case-by-case basis, which is, I think, really where the power of the driva platform comes in.
And so in terms of the driva platform and, I guess, developing the brand, what's your strategy been to raise your profile and to make sure that people are aware of this opportunity?
Yes, it's been a bit of a twofold strategy. The first one has been in a lot of the online channels. So we're actually sitting on some of those rate tables and things that I was mentioning before. We do sit on those, and then once a customer clicks through to us, they will get that more personalised experience and personalised rates stemming off that. And during COVID, we were finding that was a really promising channel for us and a really easy way for customers to find us, because I guess customers were sitting at home more and couldn't get out to dealerships to have a look at vehicles. So it did make sense for them to be shopping online. The second channel is in those offline areas like car dealerships, mortgage brokers is another channel that customers often turn to get advice on their car finance. But your typical mortgage broker doesn't have more of that in-depth car finance specific knowledge. So they do like passing it on to a specialist in the space. But for us, dealerships are a really promising area, because, you're already in the dealership, especially with a product like ours. You can literally be on an iPad in the dealership, punching in your details and then finding out your options and knowing before you even walk out of the dealership with confidence that you've got your best rate, that you've already applied for it, and that you'll have an answer in the next few hours.
Yeah, and interesting, because of course used to be that a lot of the dealers would have their own finance option as part of the transaction for the vehicle, and what you're really doing is leveraging apart those two elements.
Yeah, that's exactly right. And if we roll back 2 or 3 years, dealerships were able to charge whatever interest rate they wanted to on a customer. So even if the bank was giving them a rate of 5%, if they thought that the particular customer came in wasn't that savvy maybe, and they can get away with the 20% interest rate, the dealer would just pocket that 15% interest rate, and then make up a really large part of their revenue for the month. There's been some really positive regulatory changes in that space, which are now limiting the ability for dealers to do that. And we think that'll even go further in the future and potentially take away the ability for dealers to be providing finance unless they have that credit license, which means they need the knowledge and the expertise to be able to deal with the space. It is an area which I think dealerships are now more interested in finding a way to, I guess, act on the side of the customer for a change, instead of just trying to pocket that additional revenue.
Well, it'd be good for the customer if that was the case, I guess. And then the other question I had for you was, given the job seeker, job keeper, the withdrawal of superannuation from superannuation accounts and things, what have you seen in terms of transaction throughput and people looking for vehicles and potentially purchasing vehicles over the last few months?
Yeah, it's been a really interesting one. From a credit policy point of view, which is something we track quite closely for each of our lenders. JobKeeper it's changing on an almost weekly basis at the moment in terms of how lenders view it. So some lenders at the moment, as soon as you have JobKeeper and it's a line item on your payslip, they just won't be able to accept your application. Other lenders, they're completely fine with it. They might give a bit of a haircut to your income just in case that it isn't there in the future. But there is lenders out there, and I think what we were finding is that more customers were coming to us that did have a decline from going directly to a lender that would just say no to JobKeeper. And then that we'd be able to tell them straight away that, hey, we know these 5 lenders on our panel won't be able to look at you because you do have JobKeeper, but we have these other 5 great options for you, which are completely fine with your situation, having JobKeeper. Super withdrawals is another really interesting one, and continues to be a challenge for many customers. As soon as you've taken out super, many lenders are saying that because you've now declared to the ATO that you're in hardship, which I think is part of the process for them to be able to access their super, now we're not able to lend you money because that's against our responsible lending obligations. Again, there's huge variance in how every single lender looks at that. So it's really important to be able to know ahead of time that which lenders will be able to accept that. And I think the third big one that's been coming into play, especially in the last month, is payment holidays on mortgages, which again, almost every lender in market, if you're still on an active payment holiday, they won't be able to extend more credit to you. But then the stance of, if you've been making payments now for 1 month after that holiday, you might have access to 3 lenders, but there's still a lot of lenders in market that require 3 months or 6 months of resumed payments before they're going to lend to you. And it's, not necessarily the most fair arrangement, given that a lot of the people that did take advantage of the payment holidays weren't actually needing it, and they just saw the opportunity there, and they took advantage of it.
Interesting. And what about total volume sort of applications? Has that gone up or down in recent times?
For us, it's gone up. I mean, it helps when we're only launched in February and we're starting from a fairly low base. So, I mean, it's been really positive for us, and I think as I mentioned before, I think COVID has driven a bit of a shift to more online purchasing and online research before you start looking for your car. So we've seen a real uptick in people just purely coming through online as opposed to through that dealership model. Which, I think is a really positive shift, and it is one of those areas in the market that has been traditionally quite behind the other shifts to online that you're seeing in a lot of other areas of finance. Even mortgages are more online, and like your afterpays and your buy now, pay later schemes are 100% online. So it is interesting that car finance is taking a while to catch up, but maybe this is the kick that it needed.
And what about the mix between new cars versus second-hand cars? Do you get any information on that?
Yes. We know at a market level, it's around, from a volume perspective, it's around 25% of the market is new car sales each year. The remainder is used cars. I think it's fairly representative of our volume as well. We do play predominantly in that used car space, and I mean, there's a few reasons for that. One is, I think, more of the new car showrooms have these quite, like introductory offers if you're only paying 1% interest on your vehicle, and then they actually put the rest of the margin onto the vehicle itself. So it's not really a 1%, but it's hard for us to compete with a 1% interest rate. So we do play a lot in the used car space, and that's both private sales as well as dealership sales. It doesn't really make too much of a difference for us. Another change we saw happen during COVID was just the limitations on car stock. So because there was very few new cars able to get into the country, it meant it was really hard for customers to find new cars, and then that also flows through to used cars because customers can't trade in their used vehicles. So there was a shift during COVID to more used vehicles from what we noticed, and they're obviously more affordable as well. But many customers have been delayed by just not being able to find that vehicle.
Yeah, absolutely. Well, it's interesting because the statistics do show that some of those funds that have come out from various sources have gone towards second-hand car purchases rather than new. So it's an interesting dynamic, I guess, in the market at the moment. Now, the other question I had for you, you presumably have got some demographic information in your system. So what can you tell me about, who's most typically going to be using these online portals and platforms, age and perhaps some gender and those sorts of things?
Yeah, so this was another one that was a bit of a surprise to us as we've been carrying on for the last few months, but it's actually it's a fairly equal weighting between male and female. I think at the moment, if you go to like car review websites and those sorts of things, it's quite a very heavy male populated demographic. But on our platform, fluctuates from month to month, but it's on average about 50-50. In terms of an age demographic, we were expecting it to be actually slightly younger. We thought it would be more in that 20 to 30-year-old bracket, but it actually the largest demographic for us is more in that 40 to 50 demographic, and we do get customers as young as 18, and it's their first loan and they're purchasing a vehicle, and then as old as customers that are on a pension and they're drawing off their superannuation, and so we get the full spectrum, but the average customer is more in that 40 to 50-year-old range.
Very interesting, and as you say, that's a little perhaps older than one might have expected. But then, of course, the drift to use online tools has definitely been enhanced by COVID more recently. And in fact, from my surveys, I know that more and more people are becoming more and more comfortable with online alternatives. So maybe that's not completely, surprising now. And in terms of, future plans, are you going to stick with just the vehicle financing, or are you going to bolt on other product lines as well?
Yeah, it's a good question. Something we thought initially that we might, start with car finance and then move into mortgages and move into personal unsecured loans as well. I think what we're increasingly realizing is car finance just continues to be a really complicated space, and it is such a huge market in Australia as well, and it's really underserved. So we do really want to focus on purely that car market. Finance, there's still a lot more we want to do and to really simplify that process and continue to, I guess, tackle a broader range of customers as well. But where we're starting to go is deeper into that full car buying journey. So as an example, as a customer looks to get car finance approved, they'd also need certificate of currency of insurance over the vehicle to show that they've got comprehensive insurance. So we've started our own insurance offering through a company called Open Insurance. So as a customer gets to that stage of they're approved with finance and they need to get insurance, we can simply, instead of them having to plug in all of that detail again that they've already given us, they just need to hit a few buttons and they get quotes for their car insurance as well. So then they can take that out, and it's really an all-in-one finance and insurance offering. And then longer term, especially we've realised with the car shortages recently, it's really helpful to customers to be able to direct them to a dealership that might have the car that they want in stock. So we are starting to build out that base of dealerships that we can then refer customers to as well, and it almost acts in that reverse auction style, so that the dealerships are bidding for the customer's business instead of the other way around.
Right. And you'll focus, of course, on Australia at the moment. Are you going to look beyond Australia or just focus on the local market?
I'm sure we will at some point. There's much more we want to do in Australia first, and I think we're only really scratching the surface, so we're probably 12 months plus away before looking elsewhere. But yeah, there is a few markets in mind that may make sense down the line.
Well, I really appreciate your time today, Scott. That's been a very interesting discussion. And I think specifically, showing this move to online, showing the warts and all processes that currently exist for many people, and the fact that many people, when they get vehicle finance, don't get the best deals because they don't use the right tools. So all power to your elbow.
Thanks, Martin. Great chat.
Thanks very much.